Hey guys, as many of you know, I only started investing a few months ago, which means I've never experienced any big market crashes in the past. However, the correct ways to invest in the stock market has been deeply rooted in my mind from very early on. Still, I would be lying if I said I was totally prepared emotionally. Understanding the concepts versus actually experiencing it are two totally different things. I'm actually super lucky to have this experience near the beginning of my investing journey because I was able to gauge my risk tolerance very early on. So today, I'm going to share what I learned and have done during my biggest market crash yet. Please remember to hit the like button if you enjoyed the video. Let's begin. Hi everyone, my name is Cheeseonhead. I've only begun my road to financial independence a few months ago, and this channel is here to share my journey. The principle I learned and applied during the pandemic was simple. Don't panic sell, instead continue to buy and hold. The reason for this is extremely easy to understand. The stock market will always recover from a crash and continue to increase in value. It has done that time and time again. The recovery sometimes took months, or sometimes even years. You have to remember that you're investing for the long term, in the range of 10 to 20 years. And as history has shown, in the past 150 years or so, there are only 14 10-year periods out of 135 that had a negative return, adjusted for inflation of course. And the biggest loss is only 4.1%. This means if you invest consistently every year, your overall chance of losing money over a 15 to 20-year period is almost zero. This shows that in the grand scheme of things, crashes don't really matter at all. If you take that window and make it even longer, to 20 years, you'll notice that every single 20-year period since 1872 had a positive return. These stats include the Great Depression of 1929, the internet bubble in the early 2000s, as well as the financial crisis in 2008. So I'm pretty sure that no matter what happens, if I continue to hold my assets, I'll be in the green in the long term. However, not selling is only half the story. The other is to continue investing. The reason to do this is exactly the same as not selling, but because it requires you to take action, it's a lot harder to do. I'm only comfortable talking about it after I've gone through this once myself. During the pandemic, I knew it was the right thing to continue investing, but that still didn't stop this bitter taste in my mouth. For a few weeks straight, every time I bought ETFs, the stocks just went down further, seemingly without bottom. That caused all kinds of frustration and doubt in my mind. Why didn't I sell when I had the chance? This doesn't feel right. I'm flushing my money down the toilet. I should have bought toilet paper instead. I'm sure every investor has experienced this at some point. If not, then you better be prepared. Having experienced it firsthand, I can now totally understand why a lot of investors break at this point. I want you to know that it's totally okay to have these feelings. I think it's perfectly normal to have this kind of reaction when your livelihood seems to be at risk. It's the fear response mechanism in your brain that protects you from dangers. But if you find that your emotions take over control time and time again, maybe you should consider other forms of investing that's more suitable for you. After a lot of self-persuasion and watching a lot of YouTube videos, I finally accepted the idea that the stock market is just having a sale. Everything has a discount. And it doesn't really matter if I buy at 10% off or 20% off. I'm making money regardless. The idea calmed me down enough to finally make my decision based on logic alone. It's not to say that I don't feel bad when I lose money, but finally understanding that logic just doesn't care about your feelings. There exists an exception where it's better for you to just sell and cut your losses. This happens when you trade individual companies. Personally, I only invest in ETFs, which usually tracks an index with a particular set of criteria. And if the underlying index is sound, bad companies will usually get thrown out way before things get too bad for them. That means in general, ETFs don't go bankrupt and become worthless. On the other hand, individual companies can disappear and their stocks can become worthless. So once you have decided that the company you bought will never bounce back again, sell it, lick your wounds, and move on. Talking about buying company stocks, you can use the link in the description to sign up with Webull for free. And when you deposit $100, you can earn 2 free stocks valued up to $1,400. When I saw my new buys instantly lose money during the crash, I thought to myself, why didn't I just wait a bit more until the price is lower? The answer is simple. No one can predict the stock market, so I shouldn't even try. Here's what usually happens when I and the majority of investors try to predict the future. We almost never buy at the lowest point, because at that time, it looks just like any other downturn. The time predictors usually buy in is the slight rise after the bottom. When they decided that they have missed it, they should get in as soon as possible to not miss the rise. However, as soon as they do this, the market can, and usually will, continue crashing. So now they have just bought at a local peak. But when predictors try to factor in the possibility of a local peak by waiting a bit longer after a rise, that's when they usually miss out on the real bottom of the market. So do you see now how improbable it is to time the market just right? Personally, I've tried this myself with cryptocurrencies back in 2018. And even though I had some positive returns, I didn't attribute that to my skills to predict the market. I understood afterwards that this is just one giant gambling game. So I'm definitely not going to try this when I'm investing for the long term. I know the above explanation didn't factor in external information. And it would seem like sometimes it's pretty obvious how the stock market will go after good or bad news. However, this pandemic has shown me the exact opposite. In April, when the Feds passed the multi-trillion-dollar bill to help the economy, it seemed like things cannot and will not get better anytime soon. Because otherwise, why would they need to help it? So, it made logical sense at that moment to bet that the market will continue crashing. A lot of people did that, and oh boy were they wrong. In April's first week alone, Nasdaq rose by 11%. I thought it was just a late April Fool's joke. Since hindsight is 2020 and 2020, now a ton of people are trying to explain why this happened. To be honest, all of them actually make a lot of sense. But I just don't know how helpful that is. Because remember, the explanations that were wrong also kind of made sense. This goes to show you that yes, you can try to use logic to predict the market. But which explanation you choose to believe and base your actions on, that is the act of gambling itself. All in all, if you're understanding that predicting the market is gambling and enjoy the thrill, then by all means continue doing it. But if you believe this is a proper way to build wealth, I strongly encourage you to think twice. Since we can never know when a market crash is coming or when a black swan event will occur, we must protect ourselves beforehand. One of the first things that you should do is have an emergency fund. It should be at least a few months of your living expenses. The basic concept is simple. When an emergency occurs, you would have cash handy to cover the expenses. So you wouldn't be forced to sell your assets. Hence, you won't lose money. Also, don't put money that you need within 3 years into the stock market either. This money could be down payment for your house or cash for a new car. Even though 3 years sounds like a long time, it is still considered to be pretty short in the stock market, which means you still have a relatively high chance of losing money within that period. Can you imagine not being able to afford your dream house just because of an unexpected economy downturn? That would suck. And finally, when you're getting close to retirement, make sure to allocate a proper portion of your portfolio into bonds. Bonds are the opposite of stocks. It's extremely stable at the cost of its returns. While stocks are the best tool to build wealth, bonds are the best tool to maintain wealth. We'll definitely discuss this in more detail in future videos. So that was my first ever stock market crash. I'm not saying it's over yet, even though the numbers say otherwise. We could just as easily go into another crash next month. Hopefully, by sharing what I felt during the pandemic, helped you understand what it takes for a beginner investor to go through this kind of situation. If you appreciate me sharing my vulnerability, please don't forget to hit the like button. And if you like the channel, please consider subscribing. And before we end the video, I just want to remind everyone that Apple's WWDC keynote is next Monday on June 22nd. You can look at the time for your time zone here. There'll be software features that has been worked on by yours truly. So it would mean a lot if you can check it out. Alright, I've had enough of your beautiful faces for today. And we'll see you in the next video. Peace!